We're going to start this week's Bullion Market Update touring with Elon Musk, who visited the Joe Rogan podcast today, one of the world's most popular and widely consumed young male demographic podcasts in the Western world. We'll begin with some grade school locker room humor, and then sober up with what much of the developed world is now facing looking forward.
What we're doing right now, ladies and gentlemen, is sexy voice, sexy mode Grok AI, and it's been flirting the entire time. We're trying to get it to give us a tour of Fort Knox. Yeah, I want to know about Fort Knox too.
Yeah.
Is it true that they've been shipping large quantities of gold back to the United States recently?
I read the same thing you did, probably.
Yeah. Well, I never know what the I'm reading anymore.
Me neither.
Yeah. It's a real problem.
It's a real problem.
It's a real problem on both sides of the aisle. Do you think that all the gold is in Fort Knox?
Do I think all the gold is in Fort Knox?
Yes.
Are you a conspiracy theorist?
Yes. Yes.
What are you?
What do I like?
At the end of last week's Bullion Market Update, I flashed this U.S. gold reserve historical price value data going back to Q1 1980, when the gold price peaked at over $850 an ounce, covering about 25% of the then outstanding U.S. debt pile at the time, which was roughly only $863 billion. Our hard U.S. debt levels have since ballooned 42-fold in size to now $36.2 trillion Q1 2025. The gold price at the moment is only 3.4-folded from that peak in January 1980, the last time U.S. debt markets got dragged to the golden revaluation woodshed. And we're not just talking about our ballooning U.S. debt here either. The larger unaccounted for mess to come is the extremely large unfunded liability piles, which, depending on the net present value data you choose to source, is multiples larger than the record U.S. debt pile now and to come. It's Buzzkill time, kids.
So we just have a real issue with the budget deficit. It's gigantic. So,
Yeah.
Like if, you know, all things being equal, if we didn't have a gigantic budget deficit where interest payments, the interest on the national debt exceeds the Defense Department budget, which is truly astounding, which means so we're paying over $1 trillion of interest on the national debt, then, okay, we would have more room for wasting money, basically. But when we're spending so much money that the country is going bankrupt, then we really need to stop spending money unless we're sure it is good value.
So essentially, we're like a poorly managed business with an unlimited credit line that is off the rails.
Absolutely. Ponzi scheme of all time.
Right, explain that.
Oh, so, well, people pay into Social Security, and the money goes out of Social Security immediately, but the obligation for Social Security is your entire retirement career. So you're paying you're paying like if you look at the future obligations of Social Security, it far exceeds the tax revenue. Far. Have you ever looked at the debt clock?
Yes.
Okay. There's our present day debt, but then there's our future obligations. So when you look at the future obligations of Social Security, the actual national debt is like double what people think it is because of the future obligations. So basically people are living way longer than expected. And there are fewer babies being born. So you have more people who are retired and that live for a long time and get retirement payments. So the future obligations. So however bad the financial situation is right now for the federal government, it will be much worse in the future. At the risk of being a buzzkill here.
Did you see...
So we better fix what we got right now, because if it's bad now, it's going to be much worse in the future.
Thanks for the update, Elon and Joe. I'll take the bullion and leave the hopium for others. Moving on to another of this week's major media gold-related podcast tours, Luke Growmen went on the Tucker Carlson Show and did an eloquent job explaining the macro case for prudent bullion investment holdings moving forward for investors. I'll leave a link to the full 1.5-hour show in the show notes below in case you missed it. Here's a clip using current data and factual documents backing a few of Luke's statements from that podcast early on this week.
as the U.S. government is. That is a perception you are trying to manage. And so I think there's some element of that. I think there are other countries that have been, for example, the Chinese have been buying lots of gold. They have long said, you can find it in WikiLeaks documents from 2009, that China's buying gold to kill two birds with one stone. Is number one, it will build up and help internationalize the renminbi over time. And also, the Americans and the Europeans, they specifically said, have historically tried to prevent gold from rising too much in order to increase the prestige and the attractiveness of their own currencies. And so we're buying gold for that reason. So you get into this, gold is very much a geopolitical metal, because when you think of it in those terms, if you're China and you're buying lots and lots of gold, as China has done at times over the last 15 years after the great financial crisis, let's be clear, that can be construed in certain circles in Washington and in Brussels and in London as a tax on those nations' currencies. And so it is in the interest of nations that might want to diversify from the dollar, from the euro reserves, in which reserves are primarily,
I want to check a number while you're talking.
Primarily denominated in. It behooves those nations to have a level of secrecy around it as well. So it's that element of trying to manage currency systems from two opposite sides of the coin.
Okay, so let me. This is directly to your point. This is the Google result. If you type in which countries own the most gold, who's got the biggest gold reserves in the United States? Have you seen this list?
I have.
I'm reading this to you because it's just so clearly bullshit. It's so clearly not true. So this is in order the countries with the largest gold reserves. U.S. 1, okay. Number 2, Germany. Number 3, Italy. Okay, it's got an economy like the size of Ohio. France, Russia, China. Switzerland, Japan, India, Netherlands. You're telling me that China is 1, 2, 3, 4, 5, is number 6, and India is number 9? That's a lie. That's just a flat out lie. Like, that is not the actual ranking.
That's not the, and those.
There is no you're telling me France has bigger gold reserves than China?
And this is why when I say it's a political and
Italy?
a geopolitical metal, right? Because those are the official monetary reserves. Chinese have been bringing in 1,000+ tons of gold every year.
Have been doing? The Indians have been stockpiling gold for thousands of years. I mean, to their great credit, I'm not criticizing them.
Oh, yeah. Yeah, the chart of gold in Indian rupees looks like Apple in dollars. It's up and to the right forever.
So I guess the only point I'm making again and again and again is at the heart of this incredibly important phenomenon, the movement of gold around the world, is a lie. Like, there's lie. Like, we don't actually know what the state of play is.
There's not great clarity. No, there's
not great clarity. Right. There's massive lying. And again, whenever there's massive lying, there's going to be massive fraud.
Yeah, and there's a reason for it, right? There's always a real reason why that is.
Lease rates in the London gold market have finally fallen. Shortly, we'll look at platinum, which appears to be in partial backwardation at the moment. But before we do, London Gold Establishment spokesman Adrian Ash crystallized how flimsy the idea of filling the U.S. Treasury general account with funds to spend from potential revalued U.S. gold on the books, given our current out-of-control deficit spending situation in the United States.
But the point is, why would you do that? Because $750 billion, it's a lot of money, sure. But the fact is, the biggest gold hoard in the world, at the most high prices you've ever seen in history, wouldn't actually release enough cash to cover 4 months of the US federal deficit. You know, this is a drop in the bucket. And I think that's part of the reason gold has been going higher and higher recently, is that whilst Donald Trump, alongside Elon Musk, etc., and the Department of Government Efficiency, Doge, they're looking to try and reduce that deficit, looking to try and be more efficient in government. But the fact is, the US deficit is just so enormous that even the largest stockpile in the world of gold, at the highest gold prices in history, would be a drop in the bucket compared to what America is burning through on a daily basis.
Turning to partial backwardation beginning in the global platinum market at the moment, the current platinum spot price is lower than many of the forward platinum futures price points, which is considered a bullish sign of supply tightness and strong demand for underlying platinum bullion inventories. CME Group, COMEX, gold, silver warehouses are not alone with increased inflows of bullion inventories stateside of late. About 400,000 ounces of platinum bullion have flowed into NYMEX warehouses since late last year, December to now. The last time something similar to that occurred was during the 2020 COVID COMEX-NYMEX bullion inflow era. A rapid drain of those platinum inventories followed in 2021 and 2022, with the vast majority of those platinum bullion ounces pulled and shipped off to China. You might think gold being priced nearly 3 times the current price of platinum is a historic record. But if you look back far enough, for instance to the late 1800s, when we still did not fully understand platinum industrial applications, there were moments in time when gold far outpriced platinum. But I want to show you how crazy the gold-platinum ratio has swung within lifetimes of most senior viewers watching this video here. If we swing back to the start of 1970, with gold still at a suppressed price to start the decade of just over $35 an ounce, the price of platinum to begin that decade was 5 times the price of gold. And we just go back to 1968, the year when the then London gold price rigging pool failed. There was a time in 1968 when the then price of platinum peaked over 10 times the suppressed price of gold. Of course, the 1970s and early 1980 was a commodity bull market era with a debt and monetary crisis accounting for U.S. profligate spending at the time. Gold and silver multiplied by more than 24 and 38-fold respectively in spot prices throughout that bullion bull market era. Now, platinum historically outperforms after gold mania phase peaks as it did in March 1980. But the key point here is that I just wanted to show you how silly relative precious metal ratios can get in these full fiat currency era, quote, price discovery markets. From 1968 until now, gold has outperformed platinum via their respective historical ratios by a factor of nearly 30. Platinum might be in backwardation, but it needs to break above 1,100 an ounce and higher before platinum bulls can begin hoping the gold-platinum ratio might be finding its peak anytime soon. Hello there, this is James Anderson on behalf of SD Bullion with your weekly bullion market update. Please smash the like button, subscribe, and share this content with those who also might find value. Before we continue with this week's bullion price action and other news, a quick reminder about SD Bullion's new IRA streamlining service offering.
Traditionally, you got your dealer, your custodian, your depository.
The reason why ours is so good, first of all, we're 2 of those 3 parties, right? We are the depository, we're the retailer. The only thing we're not is the custodian. We don't get any negative experience from the customer because of how fast things are going. Who you pick is incredibly important. SD Bullion, we're different.
The spot silver and gold prices finally both sold off this week. The spot silver price closed at $31.12 an ounce bid, while the spot gold price finished at $2,857 an ounce bid. The spot gold silver ratio climbed to nearly 92 to end this week. For the last year or so, the gold price has been rising, levitated well above its ongoing 200-day moving average, which is currently closing in on $2,600 an ounce at the moment. The short and medium term question I'm pondering is whether gold pierces 3,000 an ounce anomaly in this run, or will it require a retest back toward its 200-day moving average before bull marketing higher later on? The current 200-day moving average for silver is at $30.70 an ounce and climbing. We'll see if that support can hold in this current sell-off to come. A headline from today illustrating just how silly a fiat financialized world we still live in. FT reports that Citibank recently accidentally credited a client's account not with the 280 fiat dollars they were owed, but with a brief accreditation of 81 trillion. Of course, this human and organizational operations error was rectified within the same business day, but even that amount of fiat currency wouldn't extinguish our growing U.S. debt and unfunded liability piles either. This past week, I was interviewed by SGG Report, which is no longer on YouTube, so I cut up a few highlights from our more than 1 hour discussion. I wanted to share a few of them with you here.
Sure. Now, let me ask you this regarding the LBMA. We've been tracking this for as long as you and I have known each other, and now there's smoke coming from the vaults. In fact, there has been for a long time. And as Adrian Douglas lamented so many years ago, back in 2010, by his math, there were 60 promissory notes for every 1 ounce of gold in the vault, and he expected that that would rise to over 100 promissory notes per ounce of gold in the vault in short order, and certainly it has. And now people are starting to figure that out. What do you make of what's going on at the LBMA? And how about the gold repatriation? Why is so much gold coming back to New York?
So I will definitely answer that question. The one thing I want to point out is not just Adrian who mentioned this leverage that's in the global gold market. The Reserve Bank of India, the Central Bank of India, in February of 2013, they did a study on the amount of leverage involved in the derivative paper ounces versus the physical ounces in the world. And at that time in 2013, February, they estimated it was 92 ounces derivative leverage to 1 ounce physical in the global gold market at the time. My guess is it's gotten much larger since. The leverage is probably in the triple digits, like he guessed would become the truth. So we're still in that situation. The leverage has just gotten louder and wider. And we're seeing a situation now where London is essentially, they're using the excuse of not being used to this much demand and not having that much square footage and not having that many people on hands on deck and it being difficult to get through the one place where you can actually pull an armored truck into and, myriad excuses. But the bottom line, it looks like they're running a just-in-time service, and central bank leasing is basically how these bullion banks are getting bars that are available for delivery. So what looks like is happening is that you have central banks leasing their sovereign gold to these bullion banks in order to get these bullion banks who are borrowing it and moving it over to the COMEX in order to make an arbitrage profit at the bare minimum. That's at least what's happening. Yes, this is real. It's happening. There's a couple of questions in terms of gold. There's been speculation. There's been some commentary from pretty major players in the physical gold world. The CEO of StoneX, which is one of the largest global desks in the bullion market, he said on Arabic News TV, on Sky News, that he, judging by what he was seeing, that about 2,000 metric tons had flowed to the United States in the recent last few months. What I mentioned, 20 million ounces, that's like a third of what he said, right? So we have optics on about a third of that flow. But if 2,000 metric tons is true, that means about 1,300 of those metric tons are coming in some other form or fashion, maybe in monetary gold. A lot of times monetary gold can pass through the import-export because it's classified as monetary gold. They don't have to actually show that or track it. Whereas a lot of the stuff that comes through the COMEX, it does get tracked, and you can see it in the import-export flows. But it's just gigantic. This would rival World War II flows of gold. This is basically the size of gold that's moving. It's never, in the modern era of finance, we've never seen this much gold move.
And guys, the reason we're doing this again is because I have long lamented that silver in physical form is the most undervalued tangible asset on planet Earth. Now, we've all been given our lumps, those of us who have been investing in silver for so very long, because it's stuck at 32. It's a joke. I'm sorry. It's an absolute total joke. And by the way, James Anderson is one of those guys who can give us the inside baseball on silver's true price if you take away the manipulation by Wall Street. We'll get to that on this conversation. But I wanted to ask you, in the conversation with Jensen, I asked him about Trump. And I said, look, we got all of this gold repatriating since Trump took office. And why is it? Is it Trump? Is it the tariffs? And he said, well, Trump's a convenient answer. Trump. Everything's Trump now. That's very convenient. But ... I ask you the same thing. I don't think this would be happening had Trump not won. Is it Trump? Is it the tariffs? Why is all the gold flooding back into the United States right now?
Yeah, I could give you a bunch of different reasons. The typical reason is the arbitrage. In the end, when you have a $70, $60 gap between spot and COMEX gold, that's a lot of difference. And that's like never before seen arbitrage difference. So if you can shuttle plane loads full of gold bars over the COMEX, you can make a killing. That's one reason. But if the 2,000 metric ton inflow reason is another, if that actually turns out to be true, and I don't understand why a CEO of such a big desk in bullion market globally, who has optics in a lot of places I don't, a lot of places that most people don't, if he would get on TV and say that's 2,000 metric ton inflow, he's not just going to get up there and say that if it's not credible. So I'm going to take his word and just assume that something bigger is afoot, and it's not just necessarily an arbitrage play. There's something bigger to it, and there's been a lot of speculation, obviously, with Trump, the concept of getting gold to the United States, potentially revaluing it so that the Treasury's account can get more capital in it, so they can basically revalue the gold to at least the mark to market of nearly 3,000 an ounce, as opposed to what they've had on the books at $42.22 and for forever, right? Since 1974, they've had it that way. So yeah, there's a whole bunch of speculation in the air. To sit here and tell you I know for a fact it's this or that would be disingenuous. I can only tell you what I've heard and what I've seen and what it feels like. It feels like, yeah, something's afoot. Trump is obviously going for something big. He wants to have this final term of his to be a big marker change in terms of the way the United States is operating. And he's doing it in a format that's some people don't like. They don't like the tactics he's using, but ultimately he's going for something very, very big in terms of change in this country.
I'm not an impressionist, guys, so imagine it in that Trump voice. Maybe somebody stole the gold. We're going to take a look. We're going to see what's in Fort Knox. Your thoughts on Trump's audit of Fort Knox. What are they going to find? What won't they find, I wonder?
So I personally believe that the gold that we melted down 1933, 1934 confiscation, which I've done the numbers, I've gone back and looked at the U.S. Mint mintage to what came into Fort Knox ultimately. Like 27% of all-time gold coin ever minted throughout the U.S. Mint time period, from the late 1800s until 1933, about 27%. So like 1 in 4 ounces came in. They melted it down. They stuck it on a train and shipped it off to Fort Knox. I'm pretty confident most of those bars are there. They're like 0.916, 22 karat gold bars. So when you see the old footage and the old videos, when they pick up those bars,
they're kind of wonky, right?
Well, they look like 22 karat gold. They're not pure, like brilliant 3-9 fine gold. They're not good delivery bars. And so those bars, I believe, are still there. But that's only a small portion of the overall, supposed official gold reserves. So the official gold reserves are like 8,133.5 tons, 261 million ounces. I'm talking the 90% bars. That's like a fourth of what we claim to have. I mean, it's not even half. And so the idea that they're probably going to go into Fort Knox and live stream it, and Elon Musk is going to be there. It'll be a big hoopla, but it'll be a clown show just like 1974, my guess. It's not going to be a legitimate audit. They're not going to have auditors sitting at West Point. They're not going to have auditors sitting in Denver. They're not going to have auditors sitting at the New York Fed and at Fort Knox all at the same time, counting all the bars. That's going to take weeks of work to do that right. You'd have to count all the bars and scientifically drill holes in various ones randomly and then test them, right? And so what's the number count and how pure are all those bars at the end of it? You're talking about a month at least of work. And that's not what's going to happen. What's happening right now is it's kind of seems like it's like flood the zone time for Trump to get on and start talking about gold and stir up, a lot of people, a lot of emotion. And he's doing a good job of that. I mean, you start telling people you're going to show up at Fort Knox and I hope the gold is there and that kind of stuff. I mean, that stirs up a lot of emotion and a lot of interest. So I think that's essentially what's happening. It's basically the fact that gold is in the headlines, the fact that they're doing this is bullish gold. It just is. I mean, the fact that it's being talked about as being a potential for remonetization, the fact that it's talked about that massive gold inflows are coming to the United States. I mean, the Basel III Accord, the fact that gold is literally good money in terms of on bank balance sheets now. These are all bullish gold for the long term. So I'm not saying I know exactly what's going to happen, but my speculation is it's a lot more noise than what's going to become like a true legitimate audit, like most onlookers probably would like to see.
Yeah, that makes sense. Well, the other thing we're going to talk about on this call, guys, and James has the receipts, is silver. Take it away. Will we ever see silver's fairly traded price, James?
Yeah. So this chart that I constantly use, I use it a lot in our SD Bullion YouTube channel. It's one of my most important charts when I look at kind of the shadow price of silver and theoretically what it could ultimately become in the future. It basically starts in 1970, and silver in the beginning, January 1970, it was like $1.92 an ounce. It actually says $1.92.5 per ounce, right? So that is exactly how it started, 1970. And it goes all the way to today. The red line is essentially, when you look at it, the red line is basically spot price throughout. Technically, the red line is the New York open price, but essentially that's the spot price throughout the entire time frame. Now, when I look at this chart, like, you have to understand the black line is essentially the hours that are happening during the New York hours, right? So the black line is what's happening with the price of silver from the beginning of New York trading in silver to the end of the day. And you just keep adding it up over and over, day after day. And then as you move left to right, you're moving through 55 years of time, right? So you're starting at $1.92 an ounce, and you move to today, and where has silver gone in New York trading hours? It's now dwindled down to 16 cents an ounce.
Hello. That's unbelievable.
I know. It makes your mind reel. You can't believe it. You would think that's not true. This guy's a clown. No, this is the data. Like I didn't make this up. This is Nick Lark's data from Gold Charts R Us. When I finally understood what this chart was conveying, it took my breath away. So look, now the blue line is the same thing, but it's outside New York hours, right? So theoretically, in your mind, you could kind of think, well, that's basically Asian hours and a bit of London. Okay. I mean, before we in New York wake up and start trading silver, right? So it's mostly Asian hours. So you start at $1.92 in 1970, and it's kind of normal. Like the blue line floats above spot for the most part, but now it's ballooned out again. We've had a few times where it's ballooned, and it's ballooned out so much. It's this is a February 14th chart, and it's the last price of the outside New York hours is $383.61 an ounce. The top right of the chart, you can see that price. And so, yeah, you have this, and they tell us every day, spot price is $32.35. Right. Okay, that's spot price. Okay, but these are the shadow markets that are running this thing, right? And this is the cool thing. This is what gives me hope. Is when you look at this, you see number 1, number 2, number 3, number 4, right? These are 4 different times in various silver bull markets throughout the last 55 years, where the blue line, the one that's outside, the Asian-driven one that's outside of New York, where it meets, where it converges with the red spot price line. So you see it happened in 1974's bull, 1980's bull. It happened in 2007's bull in number 3. And then in number 4, it pierced it in the 2011 bull in late April, early May, right? And so my conjecture here is that we're going to have a 5th era. And the question is exactly, at what price point and when, right? How long away? But you've seen these massive gaps expand. Like look at the 90s and early 2000s. There's a huge gap between the blue and the red line, but it converged. It converged again by 2007, at number 3, right?
Yep.
And so, yeah, so that's essentially when I look at this chart, I think, okay, well, they're going to reconverge. And when they reconverge, that's generally when you should be taking some profits. I'm not saying you sell all your silver, but you definitely should sell some of it and go buy something that's cheap and depressed. That's usually how a value buyer, goes about it. When there's a bull market, you want to take some profit and move that into a market that's not as excited, not as bullish or manic. So that's basically what this chart screams at me.
It's wild, isn't it? Tell people what that blue line price is currently as we're having this conversation. Is that just below 400? It's above 400. Where is that price?
It's on this chart. This is February 14th, right? So if you look at the very top right, you can see the words overnight last. That was $383.61 on February 14th. And, so that's basically 10 times, what more than 10 times what they tell you the spot price is. And it doesn't mean that the blue line goes up forever. Maybe it comes back down like it did in the early 2000s and reconvenes at $200 or $200. I don't know. I'm not sure. In the end, it doesn't really matter nominally, whether it's 200, 300, 400. In the end, it's like how much S&P 500 is the silver going to get me, right? Right now, it takes you 200 ounces or more of roughly 200 ounces of silver to get a share of the S&P 500. But in bull markets in silver, like it goes down to a tube of silver will get you a share. 20 ounces will get you a share of the S&P 500. So the idea of silver outperforming S&P 500 by a factor of 10 or more, that's totally out there. And that's what this chart is conveying to me. Forget the stupid fiat currency. What does it buy you in the real world in terms of real world assets, goods and services?
And dear listener, if you think that gold hasn't also been tamped down, well, James has another chart. This is the gold chart showing a similar thing, right?
Yeah. Let me pull it up. The gold chart, and I purposely put the LBMA start date in there just to put a little more pressure on the LBMA when I post this on Twitter, just to kind of let viewers kind of let that one sink in about why the blue line and the red line kind of crossed and gapped away from one another. I mean, the LBMA is essentially this member group that came about in 1987 because the Bank of England basically created it. If anyone's aware of the London AM and PM fix, they understand that during the early 2010s, there was a scandal. But the truth of the matter is, if you go look at the price data, they've been rigging the gold price for decades, literally decades. You have Peter Hambro came out, a former London gold trader in the 1980s. He came out in July 4th, 2022 on this website in London called Reaction. He published a like a I don't know, 1,000-word essay explaining that they rigged the gold price in the 1980s and the silver price and the precious metals price essentially in the 1980s with leverage, with paper accounts. And basically, the price of gold and silver have been depressed through derivatives. He basically admitted this July 4th, 2022 in an article in Reaction. And I was publishing it for the last month or two. And I went and someone alerted me that they had taken it off the Reaction website, right? So they literally memory hold the thing. And luckily, we have Wayback Machine, so I could easily pull up the article and share it with people. But if you want to understand what we're dealing with people who have been tricksters for decades about the real price discovery of gold and silver. I'm sure the people who worked in the London AM and PM fix rooms were having a ball, just making bonus after bonus, quarter after quarter, just rigging the gold and silver prices lower and getting over on everybody in the world who works hard in mines around the world, digging this stuff up. The concept that the price of gold at 2,759 on this chart right here, I mean, that's basically what they said the AM fix was on January 29, 2025 on this chart, right? And if you look at what's happened outside of London AM PM hours, the gold price outside of those hours for the last 55 years has ballooned to over $41,000 an ounce, right? And so, let's go back to 1970. The chart starts at $35.12 an ounce. Okay, that's where gold started in 1970 in the data. We're talking about London AM to London PM. Okay, that's the black line at the bottom. Okay, that's what happens with the gold price from the London AM to the London PM. And we aggregate it day after day. We just add it up. How's it doing? You can see for a while there, it went up. It went up until about 1974. And if you remember WikiLeaks exposing the fact that through U.S. Treasury cables at the end of 1974, you had COMEX and London traders basically conspiring to create a futures market in the United States that would inject so much volatility and so much leverage into the gold price that it would scare away Americans from hoarding and holding silver or gold that was being re-legalized at the beginning of 1975, right? They were afraid that in 1975, when gold was going to become legal for private citizens to own, that there was going to be a huge influx of gold buying at that time. So they wanted to create an outsized COMEX system to trade futures on so they could control the price better using leverage. And the dealers explained that, yes, by doing that, you can totally move the price with high volatility. And what occurred was, beginning in 1975, the gold price was about 200. And the next year and a half, it got cut in half. It went down to $100 by the summer of 1976. And so I'm sure they thought they had won and that they had done, a great job in putting, gold owners in their place. But obviously they lost control. 1976 summer to 1980 in the beginning, gold more than eightfolded, right? So they got overrun. But if you look at that black line, London was just doing its thing normally, it seems. The price was kind of going up as it should from the London AM to the London PM fix. But once they got the green light from the U.S. Treasury in the late 1974 WikiLeaks cable, once they got that green light, they realized, we need to actually kind of help the situation by kind of rigging the price and keeping it under wraps day to day. So it goes flat. And then it even goes down as everything's going exponential. And from 1970, 1979 to 1980, you can see that it even goes downward. Right. And the other ones are going straight upward. Right. So that means that they were in there rigging it even harder. And so if you look, that black line just goes downward progressively. So over the last 55 years from London AM PM, you have a price of gold that starts at $35.12 an ounce, and it's whittled down to $2.31 an ounce over 55 years. And that, the mirror on that is the other side, where you have a price outside of London AM PM hours that's $41,929 an ounce. So that's the situation you're in. And you can see in 1987, the blue line diverges and goes beyond the red line, where you can tell, the rig has been set. They've been doing this for decades now. And Asia keeps buying long, keeps going long, keeps buying it. But during Western hours, the suppression it's still working somewhat. But ultimately, when I look at this thing, Sean, I used to not think it, but now I do. I think the red and blue line on this chart eventually meet as well. Ultimately, it has to. There has to be a rectification of all this rigging, and it will likely meet. You're talking about 5-figure gold. I'm not sure exactly where, But for gold to be 10,000, 20,000, 30, 40,000, pick the number, I don't know where, but the red and blue lines, I think, ultimately meet, and we have equilibrium return to the global gold market.
You guys see why I like to get James on. James, it's been far too long. Good job, brother. As much as these charts quantify and show the manipulation, they still don't really reflect the 100-to-1 paper and the hypothecation and rehypothecation of the metals, the loaning out of the metals. Do these charts adequately reflect the 100-to-1 paper?
I think in some way they do. I think they do in some way, in the sense that the only way you could have gotten away with this is if you jammed a lot of the capital inflows that would have gone into actual metal and put them into accounts where there's no real metal. And so you basically just trade derivatives all day. And that's what Peter Hambro admitted in the article in July 4th, in 2022, July 4th, in the reaction article that they scrubbed from their website when this panic in London recently started. He basically admitted the fact that, yeah, we'll just jam you into these, these LBMA London gold accounts or silver accounts, and you can trade those derivatives all day. But the underlying physical, whatever, like they use a fractional reserve model where they know that people who are sitting in those derivatives never really ask for the physical. And so they just depend on you never asking for the physical and just trading derivatives. And they monkey around with the derivatives nonstop. But we're moving into a time now, Sean, where the people are going to start asking for the physical, to the point now where it's going to start making these charades, these derivative scams they've been running, fall apart. And so what I think what you're seeing is maybe the comics is front running this, and the United States is realizing we're going to have to get more gold on stateside before the London thing falls apart, and it becomes clearly obvious that they've been running a more sophisticated London gold pool than they did in the 1960s. Right? This is the most sophisticated gold price rigging scheme that has ever occurred in the world globally. It's been happening since the 1980s until now. You're talking about multi-decades of compounding rigs that have just, occasionally there's been some bull markets. Yeah, occasionally silver popped out and scared you in 2011. That's nothing what's going to happen when it ultimately moves. Silver in 2011 is, it got cut down. And we all know the story about JP Morgan just drive-by shooting everyone in the Globex market on May 1st overnight in like the least liquid hours, and then crushing the silver market for like 7 years with their Rico Suave desk, right? I mean, we know all these stories. I mean, but ultimately the pain that's going to come to these people who are short silver is going to be epic. You're going to have an overrun on the longs. You're going to have real greed and real fear drive combination of the fear is going to drive people going for the physical. Good luck getting it, because when everyone starts asking for it, it's not going to be enough. And then there's going to be a ton of greed in the levered long side of this. You're going to have a lot of different banks who are going to make a lot of money who are going to be levered long and not naked short, right? So I would expect a lot of these banks, possibly like you had in early 2008, where Bear Stearns essentially went under because they were short silver at the time, and they were getting their heads handed to them, and that bank went under. That's part of the reason why that bank collapsed, was because silver was crushing it in early 2008. So it wouldn't surprise me if ultimately, by the time this is all said and done, it takes one or two banks out easily. That wouldn't surprise me one way or another. But yeah, we're moving into the biggest bullion bull market of all time, and it's going to have some casualties, that's for sure.
Do these charts adequately reflect the 100-to-1 paper?
I think in some way they do. I think they do in some way, in the sense that the only way you could have gotten away with this is if you jammed a lot of the capital inflows that would have gone into actual metal and put them into accounts where there's no real metal. And so you basically just trade derivatives all day. And that's what Peter Hambro admitted in the article in July 4th, 2022, July 4th, in the reaction article that they scrubbed from their website when this panic in London recently started. He basically admitted the fact that, yeah, we'll just jam you into these, these LBMA London gold accounts or silver accounts, and you can trade those derivatives all day. But the underlying physical, whatever, like they use a fractional reserve model where they know that people who are sitting in those derivatives never really ask for the physical. And so they just depend on you never asking for the physical and just trading derivatives. And they monkey around with the derivatives nonstop. But we're moving into a time now, Sean, where the people are going to start asking for the physical, to the point now where it's going to start making these charades, these derivative scams they've been running, fall apart. And so what I think what you're seeing is maybe the comics is front running this, and the United States is realizing we're going to have to get more gold on stateside before the London thing falls apart and it becomes clearly obvious that they've been running a more sophisticated London gold pool than they did in the 1960s, right? This is the most sophisticated gold price rigging scheme that has ever occurred in the world globally. It's been happening since the 1980s until now. You're talking about multi-decades of compounding rigs that have just, occasionally there's been some bull markets. Yeah, occasionally silver popped out and scared you in 2011. That's nothing what's going to happen when it ultimately moves. Silver in 2011 is, it got cut down. And we all know the story about JP Morgan just drive-by shooting everyone in the Globex market on May 1st overnight in like the least liquid hours, and then crushing the silver market for like 7 years with their Rico Suave desk, right? I mean, we know all these stories. I mean, but ultimately the pain that's going to come to these people who are short silver is going to be epic. You're going to have an overrun on the longs. You're going to have real greed and real fear drive combination of the fear is going to drive people going for the physical. Good luck getting it, because when everyone starts asking for it, there's not going to be enough. And then there's going to be a ton of greed in the levered long side of this. You're going to have a lot of different banks who are going to make a lot of money who are going to be levered long and not naked short, right? So I would expect a lot of these banks, possibly like you had in early 2008, where Bear Stearns essentially went under because they were short silver at the time and they were getting their heads handed to them, and that bank went under. That's part of the reason why that bank collapsed, was because silver was crushing it in early 2008. So it wouldn't surprise me if ultimately, by the time this is all said and done, it takes one or two banks out easily. That wouldn't surprise me one way or another. But yeah, we're moving into the biggest bullion bull market of all time, and it's going to have some casualties, that's for sure.
Man, it's been way too long. Thanks so much for coming back on, brother.
I was thinking about it, man. We've talked now for almost a dozen years over time, over the years. So it's always good to catch up with you, Sean. It's always a pleasure, man. Thanks for having me back on.
Pleasure's all mine. So keep stacking, right? That's the message. Yeah. I know it sounds crazy because I get tired of it too. I get tired of feeling victimized by the banksters. Sure. But I think our comeuppance might be right around the corner.
Yeah, hold strong and keep your eye on the fundamentals. I think we've just gone over a whole slew of fundamentals that are moving our way. So keep the faith.
All right. Well, thank you for the data and your analysis. Our guest has been James Anderson, SD Bullion. Thank you, James.
That will be all for our weekly SD Bullion market update. And as always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.